This problem is not just an American problem. It is throughout the developed world. The construct that we see today is probably the most dangerous environment we have ever seen in our lifetime by a lot.
Here at Liberty and Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Welcome back to Liberty and Finance. We're always glad to have this returning guest. Michael Pento is an active money manager. He's the founder of Pento Portfolio Strategies. He joins us again on Liberty and Finance this Monday, June 13th, 2022. Michael, thank you for coming back on.
Always a pleasure, Mr. Kaiser.
It seems to be we have a very eventful day today on the markets. This has been long anticipated. Everybody's been asking every time that there's the slightest hiccup in the markets, is this the big one? Is this the big one? We don't know again today. We just know that this is a day of significant volatility in both the bond market and the equity stock markets and the metals and the crypto space. So a lot of our viewers had submitted questions ahead of your arrival. I hope to get to some of them, but first we've just got to talk about what's going on. You've been cautioning us for quite some time, over a year, frankly, but then also more pointedly as we get closer and closer to what you've been anticipating to be some potential big volatility in the major markets. Can you let us know what you're seeing currently and how you see this being part of what you've been looking for and how you see it fitting into the overall picture that you have, that people need to be aware of what's going on?
So good to be with you, Don, again. I like to appear on your program and programs like yours because I'm thrown out of. I'm like persona non grata. I'm a pariah now on CNBC and Bloomberg. I guess when you write too much, they don't like you to be on it. So I warned people in July of 21 that 22 was going to be a disaster, potentially the worst bear market we've ever seen in our lives. I don't know why that would change. What I hear from watching, occasionally I do watch CNBS and Bloomberg et al. I want to hear what the major, market gurus are saying. I don't sense any panic yet. As a matter of fact, if you go to a party and you talk to individuals, they're all saying, well, when is the Fed going to step in? And if you listen to the Jim Cramers of the world, the bear market bottom happened, maybe a month ago, he said the bear market bottom was in. And we got to look for a chance to buy the dips here. Because don't you know the Fed's going to come and save the day? Well, I just don't see that done again. I could see that. Let's just say inflation was 4%, not 8.6%, 4%. So close to the Fed's 2% target. Then you can come up with a scenario where the Fed is like, well, we're close to our 2% target range and we don't have to be aggressive anymore. Let's say the Fed's balance sheet was 4.5 trillion, where it was prior to the pandemic, not 8.92 trillion like it is today. You can't talk about the Fed turning dovish when the Fed's balance sheet is up 4.5 trillion over the last 2 years. You can't talk about the Fed turning dovish when inflation is 8.6, not anywhere close to 2. You can't talk about the Fed turning dovish if the Fed funds rate, now this is the real Fed funds rate. So you take the Fed funds rate, which is 0.75 to 1% minus inflation. If you deflate that Fed funds rate by the 10-year break-even rate, we're at minus 1.99%. If you look at the real Fed funds rate and deflate the nominal or effective Fed funds rate by CPI, we're minus 7.88% on a real Fed funds rate. Why is that important? The Fed has to get to neutral at least. So let's just say the Fed says, I don't want to be stimulative, nor do I want to be restrictive. I want to get to a neutral monetary policy. They want the Fed funds rate to have a real rate of 0. They're light years from that. Light years from that. And so is inflation above their target, and so is the Fed balance sheet, way above where they want to be. So I never got this nonsense that I heard. I was like alone on an island pretty much. Well, the Fed's got your back. Well, the market's down. Don't you know the Fed's going to come to the rescue? Don't you know inflation peaked? Who the heck cares if inflation peaked at 8.5% or 8.3%? And it goes down to 7.9, which I think it will in the next few months. Who cares? The Fed has so much work to do, and they have to do it because they're so stimulative and they've lost control over inflation. So the market is still very expensive. If you look at almost every metric on the planet, it's overvalued and has a lot of work to do yet on the downside. Until you see inflation retreat closer to 2%, and you see that happen without the economy crashing. Okay, because it makes no difference to me if the economy is crashing, but inflation goes back to 2%. So you have to have the inflation come down swiftly, yet also have a relatively robust economy. And we do not have either of those cases right now.
So a lot of our viewers have been watching and with great concern for some period of time, over a year, most of them for multiple years, waiting for some major convulsion because there's been this disconnect, as you've described, between reality and mathematics versus the attitude that's prevailed, the prevailing narrative on the mainstream financial press, just saying like, as has happened for the past 40 years, we're going to be back to the races again, and there's the Fed's got your back, and away we're going to go again. And you and others have been pointing out that there have been structural changes and just mathematical corners painted into over the past several years that say, no, we can't just persist and expect more of the same. Some of our viewers, many of them, are looking for major signs that we've reached a crisis point, a turning point, where there will be this awakening on the part of many that will actually shift the game out of this sort of delirium that we've been in. Do you see any specific indicators? You watch a lot of forward-looking indicators in your model that tell you that the game is fundamentally changing at this time.
The game is fundamentally changing to the downside? I mean, is that what you're talking about? Talking about the credit market? So if you're asking me the direction of stocks, the direction of stocks is much lower in my opinion. I monitor the credit markets assiduously, and I see fractures in the credit markets, not to the point where we've reached a massive liquidity crisis yet. So that's still in front of us. I have that penciled in for the fall of this year.
Penciled in on your appointment calendar.
Yeah, because listen. The Fed's going to raise interest rates 50 basis points in June, 50 basis points in July, 50 basis points in September. And then in September, quantitative tightening goes from 50 billion to 95 billion per month. The amount of tightening that we see right now is commensurate with the pace of hikes that we saw under Paul Volcker. So if you look at where the Fed funds rate was in actuality, it was deeply negative. It went to 0 in nominal terms, but if you look at quantitative easing, that rate was -2 or greater %. So that ended, that took the interest rate back to 0. Now we're at 3/4. Now we're starting QT. The amount of tightening is just astronomical on top of an economy that's so over-leveraged on every front. It was over-leveraged to buying Bitcoin, over-leveraged to buying tech stocks, way over their skis in the real estate market. We haven't even saw that shoe begin to drop. You have a dramatic reverse wealth effect now going on. The average, this is not me, the Vanda Research came up with the data. The average portfolio, 60-40 portfolio, stocks and bonds, is down 32% this year. Now that's shocking given what we're used to. And that's why I keep hearing everywhere I go, when is the bottom in? When do we bottom here? When do we buy? That's been inculcated to us since 1987. Well, I would ask, maybe we're in Japan, 1989. Would you ask the premier of Japan in 1989, when do we buy? Or even China in 2007, when do we buy? The answer is it could be decades away. Could be decades away because of this massive artificial construct called the U.S. economy. And that's true all over the developed world. There's nothing, look at what's going on in Japan, for example. Japan's currency is crumbling. Mr. Kuroda, who's in charge of their central bank, he has a conundrum. He could either cap JGBs, Japanese government bonds, 10 years in duration, at 0.25%. This is an insolvent nation, Dunnigan, with a quadrillion yen in debt. He's tapping the yield on the 10-year note at 0.25% by printing unlimited. He said it. I will print. This is Haruhiko Kuroda, the head of the Japanese Central Bank, Bank of Japan. I will print. He said this. I didn't say this. He said it. I will print unlimited amounts of yen every day to ensure that the 10-year Japanese government bond doesn't go over 0.25%. And then he wonders why his currency is collapsing. So then he says, oh, we have a currency problem. Well, what are you going to do, Dunnigan? Are you going to defend your currency or are you going to defend your bond market? You can't defend both. So pick it. Do you let your currency collapse and let a nation that imports almost all of their raw materials, especially energy, you watch that collapse and have intractable inflation in your country? Or do you keep on monetizing debt and peg your treasury? If you don't do that, you let the treasury yield rise to where it should be. And I would submit to you, what do you think the Japanese government bond would yield if the central bank said we're no longer going to defend the rate peg? I mean, it could be, this is not exaggeration, it could be 10% overnight. You want to buy some Japanese stocks? So this is the exact results, direct ramifications of the misguided belief that you could manipulate markets for decades with no consequences. And I say manipulate, I mean taking interest rates suppression and repression, keeping interest rates at zero and below zero for many, 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 many years. We're living in those times of reconciliation.
Man, there's so much in what you just said. It's at least three things I want to unpack with you. One is about the risk to the currency, and that's not being discussed in the main narrative that you see on the mainstream legacy media, in conversations with people. People are complaining about high gasoline prices. They're complaining about high food prices. They're complaining about some shortages of this or that, always pointing to particular, oh, this is a problem because this event happened or that event happened. And I have yet to see in that mainstream narrative any acknowledgement or recognition of the policy destruction of the currency that's been going on. And can you talk to us for a moment about that missing discussion about the truth, and the missing awareness in the part of the people about what's really going on with our currency?
Well, that's why your program's so popular, Dunnigan. I mean, you listen to the mainstream media, if they even talk about inflation. They don't really like to talk about it that much, but it's now become so salient with gas prices that,
Yeah, I mean, that almost every evening when you walk past the television, whether it's in your home or whether it's in a lobby of someplace you're walking past, you're going to see a picture of a gasoline pump or a sign at a gas station.
Yeah. Okay. So now they're starting to talk about it more, but it was where was it when inflation was running hot last year? So what you hear from the mainstream media is, Biden is blaming Putin. He called it Putin's price hike. But prior to the invasion of Ukraine, which was February of 2022, February of this year, February 24th, I believe, of this year over year, home prices were up 20%. Now, what in the world does Vladimir Putin have to do with home prices going up 20%? I mean, the fact that you don't take it, here's the scary part. So inflation was running at 7.5% in January, year over year, 7.9% in February of 22, this year over year CPI. Prior to Putin's invasion, because he invaded February 24th, the end of February, where is the self, introspection when you say, what did we do wrong? Okay, Vladimir Putin exacerbated inflation, no doubt. Bottlenecks, inflation is now 8.6, not 7.9. But taking the Fed's balance sheet from $800 billion to $9 trillion from 2008 to 2022 had nothing to do with it. Taking the balance sheet from 4.5 to 9 trillion in the last 2 years had nothing to do with it. Just so you know, and I know you do, but everybody doesn't know what the base money supply is or the Fed's balance sheet. That's high-powered money. This is physical currency and coins plus Fed credit. This is the building blocks of all money supply comes from the Fed's balance sheet, which has exploded by 100% in the last 2 years. Taking interest rates that should be around 6%, by say 4 to 6% on the overnight interbank lending rate, taking them down to zero and leaving them there for the better part of the last 12, 14 years, that's a problem. This is where your inflation is coming from. See, what is inflation? A lot of people like to say, Austrians like myself, it's an increase in the money supply. I go beyond that. Yes, you can increase the money supply, but what money supply? M1, M2, M3, M0, or base money supply? When you boil it down to its lowest common denominator, inflation is when the market votes on the purchasing power of your currency. And they believe that that is going to be debauched. It'll be destroyed. That's inflation. It's not a wage price spiral. It's not too many people working. It's none of those things. It's when a fiat currency no longer has the market support and loses its faith in that currency. And that's happened all across the board. Now, I am long in my portfolio. I have been since March of 21, the US dollar. But I'm long against the dollar against what? Against the euro, against the yen, against the renminbi. But that doesn't say, please don't think that Mr. Pento thinks that the dollar is gaining strength. The dollar is getting crushed against hard assets, against energy, for example, against homes. So, it's not just one particular currency. It's the entire construct of fiat currencies that's being destroyed. It's just a race to the bottom, which right now the dollar is winning. It's I say losing the race to the bottom against the euro and the yen.
Another thing you talked about briefly before was people not coming to terms with the fact that the market has been rolling over for the better part of a year here. We've had one of the worst first half of the year in a long, long time. There's this normalcy bias that takes over that we've talked about, where people say, well, gee, for the past 40 years, it's always just been a buying opportunity, buy the dip, and up she goes again. And you've been cautioning people that that is not structurally realistic for us in the future. I've had that experience with people calling up who are wanting to purchase physical precious metals and considering taking some of their funds out of, for example, 401ks, that sort of thing that are invested in the stock market. And they've been reluctant to basically ditch the 401k because they say, gee, I just don't want to take that huge 10% penalty for early withdrawal. And that 10% penalty, we saw that in the rearview mirror a long time ago this year. What have you been talking to people about the need to own something real, the need to own tangibles, the need to own commodities, the need to be positioned somewhere other than just in a 60-40 standard portfolio, 401k, et cetera?
As you know, I believe I run an actively managed portfolio. So I look at the rate of change of inflation and growth. So the second derivative of inflation and growth. And that tells me where to invest. I believe we're headed for an era of disinflation to deflation and also plunging growth. And where that leads to next. And by the way, I believe, the market, maybe no one else agrees with me, but the market agrees with me that anybody who manages money is saying, hold on for dear life. You don't want to miss this bottom because you want to get, set up for the next bull market. But somebody's selling. And it's not just me. I sold last year. I went short in portfolio in December of last year. I put my shorts in and have held on to them. But the next phase of this crisis, in my opinion, is a liquidity crisis. You asked about commodities and gold. We'll touch on that in a second. So, and I've mentioned to you many times in the past, when you approach a liquidity crisis, there's only 4 things that work: cash, treasuries, US dollar, and shorts. So 3 of those 4 horsemen of the economic apocalypse are galloping hard. 1 is not working, and that's treasury bonds. And I believe they will work once the market assents to the notion that, listen, GDP growth for Q1 was minus 1.4%. GDP growth for Q2, according to the Atlanta Fed, has a 0 handle in front of it. 0.9%. And I think that's coming down. And we haven't even begun. We have not even begun QT yet in any real sense of the world. So I think we shed about $40 billion from the actual apex of the Fed's balance sheet. We're going to ramp that up, as I said, 50 billion, and then $95 billion come September per month. That's the most important dynamic when it comes to the inflation-deflation dynamic. Taking away money supply, destroying money supply at that rate, which has never been done before, is the most important function when it comes to inflation. I'm looking for a liquidity crisis in the fall. And in that case, you don't want to hold anything commodity related, and that includes gold. Now, having said that, remember, I think the last time I was on your show, I was max long gold, and it was working. Several weeks ago, I took that down to 5%, my 5% minimum in gold. They're now 5% long gold. You are going to get a very limited, truncated bear market in gold as everything gets sold in this liquidity crisis. If I'm correct, and the liquidity crisis comes, anything that's not a US dollar or a treasury will get sold to raise money. That's what happens in debt deflation. You have to liquefy your portfolio to raise cash to pay back your debt. And I expect another huge leg higher in the US dollar vis-a-vis euro and yen and the pound, foreign currency. But just like 2008, the gold market's going to go like this for a few weeks and then like that. And this part of the bull market is going to take it to far and away above the previous nominal high in gold, much higher than $2,000 per ounce. Because I think at that time, the Fed is going to have no choice. When the market's down, like I said, the average portfolio is down 30%. We're in a bear market now on the S&P 500. The Nasdaq's down close to 30% for the year, this year alone. The Fed doesn't really care that much about that. They do care, but they don't care that much about the stock market. What they care most about is the functioning of credit markets. Can a company float commercial paper? What does the repo market look like in the shadow banking system for junk bonds? How are the money market funds functioning? That's what I mean when I say credit markets. Those things will begin to freeze again. And at that point, you have, the calculations would be, do I let the economy go into a depression like we have never seen before? Because that's where you would be, given the extent of the over-leveraged economy vis-a-vis 1929. We would be in the I call it the Greater Depression, as I wrote in my book, 2013. The Greater Depression, or do I just say, we could live with 8% inflation. I can't live with bread lines and starving, people starving and sleeping on the street corner. Imagine what the housing market would be if we entered into a depression. What bank would be solvent? Even if you listen to CNBS, all you hear is about the health of the consumer, the health of corporations, the health of the banking system. That's all baloney. They never talk about the fact that the consumers are completely tapped out now. They're running up credit card debt at record levels just to try to put gas in their car and to eat. That's the truth. Corporations have a lot of cash, but let's talk about the debt that they have. I mean, the reason why they have cash is because they sold so much debt. So, no, banks are not well capitalized in a Great Depression. The Fed will have to acquiesce. They'll have to reliquify the banking system. And then gold, when gold understands that you will have intractable inflation for as far as the eye can see. And when will the Fed ever talk again about normalizing interest rates? Not for a very, very, very long time. So I'm looking for a massive bull market in gold, but you do have to suffer like you are today. If you own, GLD or GDX or any other of your favorite miners, not doing well, because this is the symptoms of what happens when you're heading into a liquidity crisis.
You've mentioned a couple of things here we want to touch on. One is this idea of the ability to own real things, but how do people participate in that market? We have a question from Kenner Hotboy who says, I keep hearing that the stock market will eventually crash and commodities are where you want to be invested for the next 10 years. Most of these investments in commodities are financial or stock market plays, for example, gold mining stocks. Can you explain the conflict in messaging and how to navigate it as an individual? I keep hearing stock market crash, but invest in commodities, which are stock market instruments.
Gold mining shares are first and foremost stocks, and they will get sold. I mean, it's not my opinion. Go and back test what happened go look at the start of 2020. Liquidity crisis, everything gets sold. Everything goes to a correlation of 1. The R squared goes to 1. Everything gets sold, except for what I just mentioned, the 4 horsemen. Go back to 2008. Everything gets sold. Gold stocks will get crushed because it's a leverage play on gold, which will in itself be sold because people need cash. All right? You don't pay for debt with gold. You pay for debt with dollars. The whole world does. The dollar's losing its world reserve currency status, but it's still the world's reserve currency. And there's a tremendous amount of dollar-denominated debt outstanding that has to be repaid in foreign currencies that are being torched. Okay? Understand that. So to answer that person's question, I don't believe, even though I'm considered a gold bug and I love commodities, in a liquidity crisis, everything gets sold. You will find zero protection in commodity-related equities or commodities in a liquidity crisis. Don't look for it. It's not there.
Following on that scenario, though, once you get past the liquidity crisis, then there's a recognition, an awakening on the part of people that, this normalcy bias, this main narrative that we've been waiting for, the Fed's got your back, et cetera, ain't coming. The cavalry ain't coming. And then there's a shift into real things. Is that what you're seeing afterward that?
Well, the cavalry ain't coming as early as you need it to come because this is a new dynamic. This is a total new scenario. Since 1987, the problem has been, disinflation, deflation. How can I get to 2%? When we had the COVID breakout, inflation was below 2%. In 2008, inflation was below 2%, or right around that level. Now we have a totally different dynamic. Inflation is the problem. In fact, it's the primary problem. And the Fed understands that you can't have a normally functioning economy until inflation becomes tractable. And it just isn't. So no matter what happens outside of a liquidity crisis, no matter what happens in the stock market or the real estate market or the Bitcoin market, no matter what happens, they ignore that with the primary function to get inflation closer to their 2% target. And until that happens, look for more days like we had Friday and we're having today. We have a PPI print tomorrow. The Fed's meeting is on Wednesday. What are they going to do? Does anybody expect them now to say, well, you know what? We might pause again in September? Who was that? Loretta Mester said that the Fed might pause and take a look around in September. You can't. They can't and they will not pause until inflation is under control and or you see the economy completely wipe out. Maybe you get a couple of non-farm payroll reports that have a minus sign in front of them. That might give the Fed pause, but there's a lot of time and distance between then and now, where the market, which is still trading, the total market value of equities is still 155% of GDP. The average of that ratio is something like 70%. So you have a long way to go before we're anywhere close to fair value. And of course, markets really don't crash to fair value and stop. They usually become undervalued. So I'm sorry to give, listen, for my investors, this is wonderful. I think this is wonderful for America. I love America. You love America. We love people, love God. We want this to happen because you need it to happen. I mean, do you find happiness in the fact that first-time home buyers cannot afford a home? Is that normal or natural? No.
No, in fact, that's exactly where we were going next, was about real estate. We've mentioned it in passing a few times. We haven't talked about it yet. Paul Dreyer says, what does Mike think about housing for first-time home buyers? When should they enter? This is about 6 or 7 different questioners all asking the same thing about the housing market, wondering what your outlook is on that.
So I think home prices are going to go down between 20 and 30%. Full disclosure, I just bought a house. I bought a house because that wasn't part of my calculation. I did it for other reasons, mainly my daughter who wanted a house and wanted it then. So, I'm in a different financial position than most people. But if I could wait, I would wait, because I think we're going to have a collapse around 20, 30%. Bear in mind that the structure of finance and housing is much better than it was in 2008. Okay, so you don't have the ninja loans. You don't have the no doc, hey, I have a heartbeat, give me 5 houses. Oh, sure. Underlying standards are much stricter. However, here's the caveat, the home price to income ratio is higher than it was in 2005 and 2006. So the foundation of the home prices is much weaker. And the number of homes owned by institutions and investors is 20 to 25%. Depending where you live. So, when Blackstone realizes that their income stream from their renters is no longer there because people are losing their job, and their principal on their speculative homes is going down, that's a real balance sheet awakening. And they will start putting these homes on the market, and you'll be overwhelmed with supply. I don't want to hear, there's, the demographics, there's a lot of people. Listen, if I just told you 1 out of 5 or 1 out of 4 homes is owned by somebody who doesn't live there, that means there's a lot of supply that can come on the market if home prices stop going up. It becomes a liability. You have to pay property taxes. Your renter isn't paying. There's maintenance. It's a huge liability, and you will sell these houses on the market. All markets function on the margin. On the margin, these homes will come flooding on the market, and home prices have to drop. That's me.
I guess that's a corollary to your postulate earlier that in a liquidity crisis, or in the kind of crisis that you're talking about, that things are going to be liquidated. And that's just one more example of that.
Well said.
We've got more questions we're going to have time to get to today. There's a question about people who are Austrian economists or fans thereof have been talking about a crack up boom where there's this blow off top where it seems like the market just does this obscene melt up in defiance of all natural laws. Now, you've been pointing it to us for a year and a half or more that the valuations, no matter how you measure it on the stock market, is in bubble territory. But do you see the likelihood of yet another blow off top or market melt up before the major declines that you're talking about?
I won't mention the person's name that's popular in saying this, stocks are going to go up 80% or up 60% before they crash 80%, or one of those. I forgot what he said. Why are we even talking? This person is wrong. These people if that's the postulate, it's just wrong. It's already proven wrong. The peak of valuation in the stock market, which was at the end of 2021, was 210% market cap to GDP. Now at 150%, as I mentioned. It's over. The average stock is down over 20%. Almost 50%. The averages are now in bear market territory. The combined portfolio is down 32%. It's over. There is no crack up boom. The money supply is full. M2 is plunging. The Fed's balance sheet is rolling over. Banks are reining in credit. What in the world would be the fuel for this market to surge by 60%? Pretty soon he might be right. Goes back 60%, it'll be even, You're down 50%. You need 100% to be even. So, I mean, you might have a crack up boom, but it's over. It's a sophomoric question, not you, because I know you didn't ask that. You asked it for somebody else. It's an inane question to still expect a crack up boom because it's over. We are in the middle of a bear market. Actually, let me amend that. Let me strike that. We're in the beginning stages of a bear market, but we are in a bear market. So that's not going to happen. The chances of that happening are close to zero. Crack up boom. Now, if you say to me, will there be a crack up boom after the Fed, assents the notion they have to start building their balance sheet again? Well, yeah, that could happen. But why would they do that until the liquidity crisis happens? They won't.
Michael, you've got a lot of people who follow your work and your writings, but you also are an active money manager and helping people who don't want to just leave their financial futures to the whims of the 60-40 standard vanilla portfolio that some person in their local mini mall is going to tell them that they've got their back covered. So if people want to take advantage of your more active role as a money manager, how should they get plugged in?
Yeah. Can I just make a quick comment on that? Most people in this business, that's why I hate Wall Street. Most people are I would call them used carpet salesmen. They'll just sell you whatever their front office is pushing, whatever bond, whatever stock they're pushing. Tell you to hang on because stocks always come back. You can't time the markets, blah, blah, blah. Well, when they say they can't time markets, I believe they say I don't think they can. But we can because we understand the liquidity cycle. We understand fiscal and monetary policy. So if you get that right, what happens if you could be with somebody who could, participate in bull markets, but then save you from the 30, 50, 80% declines? That may not bounce back as quickly as they've done before because there just isn't the ability for the Fed to turn on the liquidity spigots like they did before. I want to say this real quick because I know we're going over, but if the Fed were to turn dovish in the immediate future, in the next few quarters, remember the scars of inflation are there. People understand what happens now. You don't have to, the last time we had inflation was a problem was 40 years ago. I mean, how many people have been in this business for 40 years? Very few are still working, have seen the 70s and the early 80s. But we all know now the consequences, the ramifications of going back to zero and printing trillions of dollars will be, and helicopter money with the cooperation of Janet Yellen at the Treasury. We all know the ramifications are intractable inflation. Those are the ramifications of helicopter money. So if the Fed were to pivot again anytime soon in the same capacity as they've done in the past, I would not automatically assume that all stocks will bounce back. Certain ones will, those based on stagflation, but not those that are based on, bond and bond proxies. Those will get murdered. If you're interested in to learn more about what I do, of course, it's Pento Portfolio Strategies. The website is pentoport.com. The number there is 732-772-9500, and you can email us through the info icon under About Us or contact us on the website.
Well, thank you, Michael. We do not mind that you've been blacklisted from mainstream media. We always are welcome here on independent media because this is where we're getting the word out.
Why would you black? I'm such a nice person. Why would you blacklist me? What if I called the Fed serial counterfeiters? Is that really a problem?
The serial counterfeiting is a problem. The speaking truth about it is not a problem. In fact, the problem is that it hasn't been spoken about widely enough. My wife is now getting weary of me railing at the television if we walk by and they say, why are they not talking about this? Why are they not? They're pointing everywhere but at the actual problem. It's like, so that's the malpractice. That's the dereliction of duty on the part of the media, on the part of the financial elite, et cetera, that is hurting. That's where my heart hurts the most. Thinking of ordinary, hardworking people who've worked their whole lives, tried to set aside for their future, and are now being robbed from because they're being lied to or by omission of the truth. That's very important for people to hear. We're grateful for your part in counteracting that by being here to, call from the rooftops about what people need to be aware of so that they can make the kinds of decisions that will help protect their family's financial futures. Any final parting thoughts from you before we let you go?
I was just thinking about Europe.
We've been speaking with Michael Pento, founder of Pento Portfolio Strategies and active money manager, this Monday, June 13, 2022. Michael, thank you for coming back on.
My pleasure as always, Donegan.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Donegan, call 1-888-81-LIBERTY. That's 1-888-815-4237.